Hello, so today we're going to present our project report for AGR 113. We're from group 3 and this is our group members. First, this is Dorshare Kaisara. Second, Livena Indun. And last but not least, me myself, Murdin Suling. First, I'm going to introduce about the FELCRA Berhad. FELCRA Berhad established on 1 April 1966 when the late Tun Abdul Razak bin Dato' Hussein was the Deputy Prime Minister. FELCRA was established under a provision of law known as the Federal Land Consolidation and Rehabilitation Authority Act 1966. The initial goal of establishing FELCRA was to develop the rural sector by helping them participate in the country's economic activities and improve their standard of living and value of life through community involvement in the agriculture sector. Among the purposes of establishing FELCRA at that time was to overcome the problem of the government awarding land to the people without any assistance to increase the income of the rural community, especially in developing the land for agriculture purpose. In addition, the problem of inheritance of land by the rural community, the area of the land was getting smaller and smaller, making it uneconomical and ultimately unable to help the rural community in increasing agriculture production. As a result, many rural land were abandoned and could not be developed for agriculture. Next, I'm going to talk about the concept of the production cost. First, the input and output. The input refers to the factors of production that a firm uses in the production process. Next, the output refers to what we get at the end of the project as a finished project. Second is the fixed input. The fixed and variable input. The fixed input is on which the quantity of the input did not change according to the amount of output, while the variable input is an amount on which the quantity changed according to the varieties. And the last one is the profit maximization, which is the primary goal for every company, involve a strategic decision, and last but not least, an essential to balance profit and other consideration.
Hi, my name is Liviana. I will explain the cost of production starting with total variable cost. Total variable cost or TVC refer to costs that change according to the level of production. Total variable costs include farm labor costing 1,002,000 ringgit, fertilizer costing 800,000 ringgit, pesticide and maintenance amounting to 500,000 ringgit, fuel and logistic costing 300,000 ringgit. As a result, the total variable cost is 2,800,000 ringgit. Now, let's move on to total fixed costs. Total fixed costs or TFC refer to costs that do not change with the level of output. These costs must be paid even when production is low or stopped. In this case, the fixed costs include management salaries of 600,000 ringgit, depreciation of machinery amounting to 400,000 ringgit, land rent of 300,000 ringgit, and insurance and utilities costing 200,000 ringgit. Therefore, the total fixed cost is 1,500,000 ringgit. Next is the total cost and average cost. Total cost or TC is the sum of total fixed cost and total variable cost. In this case, the total variable cost is 2,800,000 ringgit and the total fixed cost is 1,500,000 ringgit. Therefore, the total cost is 4,300,000 ringgit. Average variable cost or AVC is calculated by dividing the total variable cost by the quantity produced. With a total output of 10,000 tons, the AVC is 280 ringgit per ton. Average fixed cost or AFC is found by dividing total fixed cost by the quantity produced. This gives an AFC of 150 ringgit per ton. Average total cost or ATC is calculated by dividing total cost by total output. Hence, the ATC is 430 ringgit per ton. Last but not least, I will explain the total revenue and average revenue. The selling price of fresh fruit bunch is 720 ringgit per ton. Total revenue or TR is calculated by multiplying price by quantity. 720 ringgit multiplied by 10,000 tons give a total revenue of 7,200,000 ringgit. Average revenue or AR is calculated by dividing total revenue by quantity produced. Therefore, the average revenue is 220 ringgit per ton. Next, I will pass this to Cheryl to present the profit.
My name is Nur Cheryl. Now it's my turn to present about a project profit. FELCRA's oil palm project shows strong profitability with recent reports highlighting significant interim distribution to participants driven by high crude palm oil prices and increased yields, with an 81% net profit increase in oil palm project and cost reductions leading to substantial payouts like 101 million ringgit distributed in August 2025 for the 2025 period. Key factors include efficient management, reduced operational costs by 15% and higher yields per hectare, making FELCRA a major contributor to rural economic development. Profit is equal to total revenue minus total costs. 7,200,000 ringgit minus 4,003,100 ringgit equal to 2,900,000 ringgit. This is a recommendation to improve FELCRA oil palm. First, strengthen internal controls. Implement robust governance, risk assessment, and proper documentation for high-value transactions like land acquisition. Next, adopt good agricultural practices. Implement IPM, beneficial plants or houses for pest control, use of empty fruit bunches as mulch, and leguminous cover crops to improve soil and reduce chemical reliance. Next, zero burning. Continue zero burning practices during replanting to comply with Malaysian sustainable palm oil and improve soil quality. Last but not least, the debt management. Implement strategy to control debt, improve cash flow, and update debtor records, also settle the payment. So, in conclusion, this analysis shows that FELCRA Berhad has a well-controlled cost structure and it is able to generate good profits in the oil palm plantation sector with more efficient cost management and yield improvement strategies to company profitability be further enhanced in the future.